Hi, my name's Dan Wells. I'm a partner at Foresight Group in the infrastructure team, and I'm here today for the fourth episode of our Investing with Impact series. This is a special episode where I'm interviewing Peter Smith, a senior investment manager at TPT, one of the UK's leading multi-employer pension schemes, and we're going to be specifically talking about reflections that Peter has as a major investor, a major manager of a pool of capital in the UK on the recent forum we had at Eden, the Foresight Sustainability Forum, and reflections he has around investing in sustainability given the context of everything we've been talking about there. So Peter, it's great to have you with us today. Thank you very much for taking the time. I thought we would start off, before we go into specific reflections on the conference itself, talking a little bit about how the UK pension sector has a role to play in sustainability, and even looking beyond that, the whole concept of pools of pension capital and savings, and the role that might have in helping to drive net zero. So if you could talk a little bit about just how you see all of that working and why this is such an important area for investors and for everyone really to kind of understand better, that would be fantastic.
Sure. So I mean, first of all, UK pension scheme is large, so that it has about £1.5 to £2 trillion in assets. So there is clearly a huge pool of capital available there to help further net zero or wider sustainability objectives. Traditionally, I think pension schemes and pension scheme objectives have been very much focused on member retirement. So we are ultimately here to pay pension and benefits in retirement. It's very much how do we achieve that, focus on risk and return, traditional financial metrics. I think what's becoming increasingly relevant and important is that trustees actually take a wider view of those outcomes. So members increasingly want to use that money that's being put aside to actually further their objectives during the accumulation phase. So they're saving for retirement. How do we actually use that money to better their lives today as well as provide income in retirement? So I think there's pressure on trustees from a number of areas. So, members are increasingly becoming more engaged on this. You see NGOs and standard setters, so regulators. I think there's increasing regulation on trustees, not just to fulfil their fiduciary duty, but also to take account of a wider set of factors when they're making investment decisions. So I think it's really important that pension schemes start to think more broadly about how their pool of capital is actually impacting on wider society, rather than just the narrow focus of providing income in retirement.
That's really interesting. And so it's extraordinary to think about the amount of capital that this represents. So 1.5 trillion of capital in UK funded occupational schemes. So how do you kind of see that acting as a pool of capital, and what do you think we can achieve if we're better able to harness it and kind of guide it?
So I suppose most countries would call it a sovereign wealth fund. I mean, ultimately that's what it is. The trouble that the UK has is that it's quite dispersed, that pool of capital. So there's about 5,500 DB pension schemes in the UK. So individually they are quite small. I think what is starting to happen in the industry is you're starting to see this pool of capital being consolidated, being run in a more professional manner, and that's enabling trustees to actually start to invest in a wider set of assets, be it infrastructure, or longer dated assets that you can then start to factor in other sustainability factors. I think it's quite difficult as a small pension scheme with limited governance budget to invest in assets that are long dated, complex, often quite expensive. So on their own, it might not, from a risk return perspective, net of fees, it might be quite expensive. But I think once you start to scale that up and think of it as a £1.5 trillion pool of capital, actually you can access a wide range of assets relatively cheaply. Canada's already doing this, large pension schemes in Europe are already doing this, and I think that makes it easier then to start to say, what impact is our capital actually having on society at that £1.5 trillion level, rather than each individual pension scheme thinking individually And often the challenge we get when we speak to sponsors is, actually, you're quite small. I mean, we have around 10 billion assets. We're a medium to large size pension scheme in the UK. But on our own, we're probably too small to drive change on our own, so we have to collaborate with other investors. If you can harness that capital in aggregate, I think that makes it much easier to bring about change.
Yes, exactly. Well, I imagine if you're looking at the sustainability transition as a big kind of blank canvas for investing, there is a lot of complexity there. Things are changing rapidly. 10 years ago, you could look at investing in a wind farm or a solar farm in isolation because they had a subsidy contract associated to it. Now things are much more complicated. The energy system is much more interconnected. We're talking about economy-wide net zero, so investing in all sorts of different subsectors: industry, food and agriculture, natural capital. So I can imagine, therefore, that it is difficult for smaller funds, smaller organisations to simply have the resources to kind of track that. So if pooling and aggregation of capital and skill sets and resources is important, how do you see that happening, and who do you think are the sort of the crucial actors here in terms of making that work?
Yeah. So I mean, just on your first point, I think you're right. The challenge is the knowledge gap. So a lot of nascent technologies might seem quite complex and challenging and daunting. Actually, that might be the best time to invest in them. So if you invested in renewable infrastructure back in 2010-12, when you could still get subsidies, you could still make high single, double-digit returns for what was effectively a government contract. You can't do that today. So if you're 10 years too late to the game, actually the investment opportunity, albeit it's more proven now, actually it's less attractive from a pure investment perspective. So that knowledge gap with trustees and their advisors is something that needs to be addressed, because whilst it's not within the remit of trustees and pension schemes to fund new technologies, often that's where the most attractive investment opportunities are and where they can have the most impact for the least amount of capital deployed.
Yeah.
In terms of who's driving the change, ultimately, I think regulators and governments have got a big part to play in this. Standard setters, we see the IRA in the US, attracting large pools of capital now. You go to manager meetings, that's generally the first topic on the agenda. I think what we're starting to see from the UK government is clearly it made its net zero commitment in 2017. It is starting to think of its pension scheme pool as a pool of capital it can use to further its own political objectives. So it's formally put in place TCFD reporting, so the Task Force for Climate-Related Financial Disclosures. That came into force on the 1st of October 2021 for schemes over 5 billion, and that was extended last year to schemes over 1 billion. I think so what we're starting to see is governments and regulators say, we have this large pool of capital that we are regulating. We want you to now start reporting on how you're using that capital, not necessarily to directly further their own objectives, but the two should be aligned. And I think once we start to see measurement of those numbers, so via TCFD, carbon intensity and absolute emissions of portfolios, they can actually then start to act on it, start to create rankings. And I think that ultimately then starts to push pension schemes and trustees to think how they're doing relative to their peers. The PRI survey is a good example. Nobody wants to be in the bottom quarter of the PRI survey. So trustees then start to say, if we're going to become a member, a signatory, what are we doing to actually put ourselves in the top quartile relative to our peers? And that, I think, in itself pushes action.
Got it. That's really interesting. And then just to help us understand a little bit more in terms of the overall landscape of the pension world, and just broadly how these kind of pools of capital break down. In very simplistic terms, there's a corporate pension fund world you're talking about, then there's the local government pension scheme world. Do you see there are very different dynamics there, or do you see that actually we could be thinking about this holistically and pushing those pools of capital in the same kind of direction together?
I think historically they're viewed as very separate. LGPS pools, so LGPS pension schemes were small pools of capital managed by individual councils. Clearly the government drove the regulation to aggregate that capital. Ultimately, I don't really see that much of a difference between the two pools. They're trying to achieve the same thing. They're trying to support members into retirement, and they have an amount of money they can invest today to achieve that and achieve a wider set of sustainability objectives. The nuts and bolts might be slightly different, and covenants are different. So one is a corporate covenant, so you might have to invest slightly different compared to where you have a government covenant. But ultimately, they're trying to achieve the same thing, and probably investing in a very similar pool of assets. So from that perspective, I don't think they're actually that much different. And that's why I don't sort of necessarily see you should start disaggregating into local government, corporate pension schemes. I think the biggest challenge is actually the transition from defined benefit pension schemes in the corporate sector, defined contribution. A lot of the investment opportunities that are open to us in the DB world, and we manage both DB and DC, are just not there yet in DC because of regulation, because of cost, and because of the size, because DC is quite nascent. The amount of money invested in DC is quite small on an occupational pension scheme basis. So I think it's probably another couple of years, but ultimately that's probably the future of saving.
Got it, okay. And is there anything you would say to us all as members of schemes ourselves? Like what would you say in terms of, are there ways in which you would suggest we engage? Should we be writing to our pension fund providers to push them in particular directions? Would you like to see more member engagement at all?
Yeah. So yes, but it's also a challenge because unfortunately the only people that tend to write to you are the people that already have very strong views. Very few people write in and say, what do you think about this situation, and therefore enable us as a pension scheme provider to engage with members. What we tend to see is members have very strong views held already, asking us to do something. And we have over 350,000 members. So it's quite difficult to take into account every member's specific requirements. But what we can do is if we can start to get a sense of what does our membership think are the most important issues facing them, we can then at least start to align our beliefs with our members. And I think that's really key in terms of how investment strategies actually set. We often like to focus on the nuts and bolts. What investment fund are you invested in? What asset are you buying? It actually starts much higher up than that. The first thing that a pension scheme should do is set a set of investment beliefs. What does it want to achieve with the pool of capital it has available to it? Traditionally, that was we want to achieve a return commensurate with the level of risk we want to take. We want to pay member benefits, and there'll be something in there about active versus passive, the old debates around how you access listed equity investments. I think what trustees perhaps need to start doing is, along with that member engagement, is saying, what else do we want to achieve? So we might want to achieve a certain level of return and risk. Are there perhaps externalities that aren't currently priced into those expected returns that we need to start taking into account? What part of the energy transition are we funding? What impact is it having on biodiversity? And I think increasingly the government's also starting to talk about social impact. The problem is these are quite difficult to measure. So risk and return is quite well known. There's various models you can buy in to tell you the risk of your portfolio. Those external impacts are still very new and quite difficult to set an objective and a level of ambition with those.
Okay, that's okay. Well, that's really helpful to for you to set it out there. And when you think about examples you've seen overseas, you talked about thinking about this as kind of a sovereign wealth fund. Are there any good examples you can look to? Would you look at somewhere like Norway, for example, as like a good example of like a really long-term plan for a national pool of capital to be put to work in a particular way?
So I don't have a specific example about a country, but I think generally what you see, particularly in continental Europe, is they have large internal teams that have multiple disciplines and specialisms. So you might have a traditional strategy team, you might have a quant team, but then you might also have a dedicated sustainability team. And I think what that enables those pension schemes to do is take into account a wider set of factors when they're making investment decisions. Yeah. They're able to tap into different thinking. And I suppose, we talk about diversity and inclusion and how people can think differently. Yeah. It's very difficult to get that in a small team because there's a certain set of tasks that you have to do. Yeah. You have to set strategy, you have to invest the money. And if you're operating in a very small team, getting that diversity is quite difficult. So I think that larger team and diverse backgrounds just enables you to take different things into account. So I think that's probably more important, that you're able to harness different viewpoints, different backgrounds. And ultimately that's where we came from. Back in 2010, I'd probably be honest, I don't think we probably thought about sustainability. We hired in a dedicated resource that had a different viewpoint with a particular focus on responsible investment, as it was called. And that enabled us to start thinking about our investment strategy differently and how we can then use that pool of capital to achieve other objectives.
Has there been more engagement from your members on sustainability in recent years?
Unfortunately not.
Do you have a sense as to why that is?
So I think probably historically we're defined benefit. So I think there's very little link between the member and the corporate and the trustee. Ultimately, a member pays into their pension scheme and is guaranteed a retirement income. So I don't necessarily, I'm not sure whether they view that as their savings, as their money, even though it is. Yeah. I think we're starting to see that change with defined contribution. But as I've already said, defined contribution at the moment is still a relatively small amount compared to DB. But I think technology may be changing that. You know, you see pension consolidators using technology as a way to try and engage with members to make it easier. You know, the pensions dashboard, I think, has been pushed back to 2026. That might be a way for people to actually start to realise, oh, I've got this money invested. How do I engage with it? But at the moment, I just don't think members necessarily, and it's not their fault, it's just the way that the financial system works, necessarily feel that engaged with their money.
Okay, interesting. All right, thank you. And you mentioned externalities. Are there any particular externalities that you worry about that the market is not properly pricing in?
Well, I think it's probably, it's probably the same ones that we're talking about at the Eden Project. At the moment, it's climate and biodiversity. They're the two that I think have dominated our thinking over the last 5 years. Perhaps to the detriment of other things. So I think we're starting to maybe come to the end of everybody just talking about climate, that being sort of the easy one to address. But I think what we are starting to see is there's lots of reporting, particularly around climate. The next question is what action is being taken once you've measured. So that's where we're seeing very little action. I think there's, people are telling us what their carbon intensities are, carbon footprint, coming up with different products. The next bit is how do we evidence action? And I suppose with us around, we are an active voter, we vote our shares, we engage with companies. How do you evidence that your engagement is actually driving change? So that's the next challenge. And then we talked about biodiversity. One thing we are currently looking at and thinking quite heavily around is natural capital. It's becoming an increasingly popular, term. I think certain people have been investing in forestry for quite a long time. It provides an income. But I think with COP15 last year, biodiversity and potentially, task force for nature-related financial disclosures, that's maybe coming down the track. We need to start thinking about what are we doing? How can we have a positive impact? But the challenge there again is, unlike carbon, it's quite difficult to measure. So you might invest in a forest because you think it's a good carbon sink. How do you actually measure the effectiveness of that investment? And taking one step back, can you even access it in a scalable manner? Okay, so that's really helpful. So if we move on to talking about some of the themes we talked about at the Eden Project for the Sustainability Forum, I think that axis of climate and biodiversity, or you could call it energy transition and natural capital, it's the same kind of thing. Let's just sort of let's take those in turn. So let's go into energy transition first. We had some brilliant speakers at the forum. We had Chris Skidmore setting out his highly articulated and comprehensive view of net zero and how to drive that. We had Kingsmill Bond from the Rocky Mountain Institute, the RMI, set out where we are in the energy transition and making the case that things are happening potentially more quickly than people realise. I'm going to try and temporarily channel a bit of Kingsmill's energy here and give some of the quotes that he gave at the conference. So paraphrasing him a bit here, essentially he's saying we have this opportunity now to be tapping into a far superior energy system. We're moving from an expensive commodity-based fossil fuel system that channels millions of dollars to oligarchs and petrol states, concentrates power and leads to climate breakdown,
moving to an efficient technology-based renewable system with falling costs 100 times larger than fossil fuels, which is available everywhere, liberating people from energy dependency and the curse of oil. We're moving from heavy, fiery molecules to light, obedient electrons. An exponential energy change is happening all around us. The stats he gave is that from solar, we've gone in a decade from 50 terawatt hours to 1,200 terawatt hours. EVs have gone from being irrelevant to 14 million in sales a year. Batteries have gone from a pipe dream to 50 gigawatt hours. So my question to you is, we're painting this picture of things happening very quickly, and having to look, and in terms of gauging that, looking at the flows rather than stocks of things, and EVs is a good example of that. So do you buy this kind of picture of things? And if so, how do you see that, or to what extent do you see that changing the investment landscape from your perspective?
It's very positive from Kingsville. So yeah, I mean, to a certain extent, I think we've seen it over the last 10 years from an investment perspective, that it's actually becoming an investment opportunity. And that's the challenge, right? Is that I think one of the things from the Eden project that we saw is there's lots of different stakeholders that need to be brought together to actually advance the energy transition. Regulators can't do it on their own. Investors can't do it on their own. They need to have a regulatory environment that's useful for them to invest in. And then there's other people around, technology providers. So yes, I think we've started to see it. The challenge we've got is that we've seen it mostly in developed markets. I think all of our investments over the last sort of decade have probably been in continental Europe, starting to see it in North America, but very little in emerging markets. And I think one of the things that came out of the Eden project was a comment around 2/3 of the growth has come from, emissions has come from emerging markets. How do you access that? There's very few products or investment opportunities that are purely emerging market. You've got the challenge around political risk. What level of return do investors want or need to move their money there? So I think that's the next challenge. We focus on the easy wins. Wind is now well-proven technology. Actually, with solar, the challenge is now, is it investable at an attractive rate of return? If you're locking your capital up for 30 years and you're achieving mid-single-digit returns, that's probably not that attractive compared to other liquid assets you can invest in. So that's probably a challenge where it's become too competitive. But in the emerging markets, it's how do you access investment opportunities there, and how do you divert capital to those opportunities? So
what's your perspective on emerging markets at the minute? Would you invest there, or do you see the?
Yeah, we do. Yeah. So I mean, we're a universal owner, so we invest globally. We have listed equity investments in emerging markets. We've got a few energy-specific investments in emerging markets, primarily in Asia, but more developed Asia. We don't have anything, for example, in India or Latin America. We did have a small investment in Latin America. The problem there is the political risk. There was a change in government that sort of started to promote the local oil producer as a preferred energy source, and that really brought home actually the real challenges investing in some countries where the regulatory environment might not be as stable. I think that's the key bit. As long as the regulatory environment is stable over the next decade, you can plan. You know what level of return you need to achieve to offset that level of political risk. The difficulty is where political environment changes and therefore regulation changes.
That's right, exactly. So that the concept of kind of soft infrastructure is really important here. The contract law, how solid is that? The rule of course. And that is something that we clearly have to factor into our decision making as investors. In terms of incumbent vested interests being a barrier, so you talked there examples about local kind of fossil fuel interests proving a barrier. I guess one argument is that over time that should kind of flip around as renewable energy becomes the incumbent industry. It becomes the vested interest. You could refer to examples in India recently, where over the last 5 years there's been a bit of a revolution on the solar side. Solar is the cheapest form of energy generation in India, as it is in most places kind of around the world. There's also been a big build out of the grid infrastructure, which is enabling much more kind of renewables to be installed. So it may be that we go through these kind of tipping points in the coming years, which in turn accelerates more renewable energy deployment.
Agree, but I think you mentioned the grid there. I think one of the things that came up from Gus's presentation at the Eden project was that I think their grid connection's 2036. So there's lots of technology out there, there's potentially a lot of will. So we're talking about governments and regulators. They also need to keep pace and enable reforms to take place to actually make those investments viable in the short term, not in 2036. So there might be a pool of capital waiting to go in, but if you might be able to build it, but if you can't connect it, that's going to pose a problem, because ultimately a lot of these assets we're investing in them from income. We're not necessarily investing for the capital gained through developing that asset, although that's one opportunity. But as a long-term investor, we might say, okay, we want a 6% yield. So actually it's really important for us that that asset is up and running, connected to the grid and operational to gain that income. If you can't connect it and you can't get income off it, it makes it very challenging to go and invest in it.
I think that's such an important point, and there's kind of multiple dimensions to that point. You're making the point that we need a whole bunch of different things for the energy transition to work. It's not just the renewables, it's the grid itself, and that's just an overriding message, as you say, coming out of the conference, that we need investment in the grid. That also throws up this question when we look at the developed world and emerging markets of, is it easier or difficult to kind of retrofit an existing developed grid, or is it easier actually to install renewable energy when you're slightly more starting from scratch? If you're looking at kind of sub-Saharan Africa, there are some advantages where you don't have a grid at all, when you are starting from scratch. It also throws up the question of, do you go for the really big scale stuff, or is it more localized and distributed? The big scale stuff has the advantage that you can build wind at huge scale now, and with long range transmission lines, you can take wind from where it's being generated, often in remote places, either out to sea or up in the mountains, to where it's being consumed in urban centres. But I think the problem there is the grid connections, is the permitting for these things is really, really difficult, especially when you're going across multiple state lines and different countries. That really is an inhibitor. So quite how we're going to end up in this kind of balance between really big stuff and then the small distributed energy where people have solar on their rooftops, we'll see, and there'll be some kind of balance will be struck, I think.
Yeah, but you're right. Present opportunities and challenges. Like I think you said grid is the challenge. Why can't private investors, commercial investors, why can't they get more access to grid financing? It's a national, or it's a very strategically important infrastructure asset, but ultimately it still needs financing to change. I think that's one of the challenges, that wind's easy to get finance for, solar is, but grid and supporting technology, so what do you build around those transition assets, is equally important to the asset itself. And I think that's something that we should be looking to finance. We can finance. It's making those investment opportunities available quickly and at scale, and that's probably the second point, at scale. So I think one of the things we're starting to see become increasingly important is things like energy efficiency. How do you finance energy efficiency? How do you finance those small on-site generators rather than the big centralised ones? I think it was Chris Skidmore was talking about, how do we decentralise the energy grid? That sounds great, and it is great. The problem is, how do you then achieve that at scale? As you say, particularly in countries where there's different jurisdictions or different regulations, what large institutional investors want is to be able to put large amounts of capital to work fairly quickly, not immediately. We recognise that there's a ramp-up period, but you need to see the opportunity available to you to allocate to it. You can't make an allocation based on the promise of an opportunity that doesn't yet exist and has not been proven. So that's the challenge about scale and speed of deployment over a decentralised system, which is easy to finance because you can see it, and it's got well-financed bond or debt to it. You can put in equity quite quickly.
Mm-hmm. Yeah. I think that's exactly right. It feels like there is so much. This is coming from the fund manager perspective. There's so much of a role that private sector capital could play, and transmission infrastructure might be the best example of that. These assets built at scale with long-term contracts in place are classic infrastructure investments. The challenge seems to be that almost universally around the world, these are assets that historically have been financed by the state kind of grid companies, and we just don't have the structures yet to enable private sector capital to get to work. And you touched on there the concept of kind of distributed energy assets. So things like energy efficiency projects rolled out at scale, small scale solar, small scale storage. We've been saying this for years. We need an evolution of the way that contracts work there, standardisation of contracts. Standardisation of contracts for commercial solar projects, for example, would be fantastic and would really unlock the energy transition. There was a fantastic headline in The Economist a few weeks ago, which actually slightly encapsulated one of the debates we were having at Eden, which is the role of technology and the role of investment in nature. The headline...
What was the answer?
They were both. Well, exactly. We'll come to that in a second. The headline in The Economist, I think, was "Hug pylons, not trees." So it's making the case for why we just need a really big and rapid investment into the energy grid itself. Electricity is getting cleaner. 2/3 of electricity will be generated from wind and solar by 2050. But we just need way more electricity as things like heat and transport get electrified. The electricity space will be 3 times bigger by 2050, as well as being cleaner. We talked about technology and nature. Obviously, these things are these debates are a bit contrived because clearly there is a role for both. Were you a technology person or a nature person, and was your view changed at all?
Probably a technology person, although purely from an investment perspective, I think there's a lot of technology out there that's being promised as a solution that is not yet come to fruition. CCUS is clearly the classic example that everyone uses as a great example of new technology coming. I have not seen it as a recognisable investment opportunity as yet. And so if private finance is one of the key elements to that, along with public financing and standard setting, then there's certain areas of technology that are perhaps lagging where the promise has been made. We talked about, I think there was an article in the FT about the size of or the expense of the hydrogen economy. So it's making sure that we're financing the right types of technology to bring about change as quickly as possible.
Exactly. And I wonder I think an argument I would make here is if you start with the problems and then figure out which are the best technologies to apply, that's a better way round than starting with a technology. Hydrogen's a good example. Hydrogen will have multiple roles it will play in the energy transition. But if you start with a solution and then look for the problems to solve with that solution, sometimes you can end up with slightly inefficient approaches. And certainly carbon capture and storage is one of those areas where, yes, there's been a lot of promise over decades, and quite frankly, we haven't seen any meaningful progress at commercial scale there. But in terms of investing in nature, you're a self-proclaimed technology person now, Peter. How would you view prospective investments in the natural capital space? And I think we can frame that by we did a survey during the debate, during the Eden sessions, on what were the returns people were expecting from natural capital assets, and the answer was there was quite a big range. It was sort of, there was the 5 to 15% kind of range, but going beyond that as well. How do you view the kind of gamut of natural capital potential investments as of now? I
think the biggest winner was 10 to 15%, if I remember. So people are expecting pretty sizable returns from that. I think the challenge for natural capital, so if you take a step back, what does natural capital investment mean? I think that's the first question that investors probably need to answer. It's a new term. I think nature-based solutions is another way of looking at it. Traditionally, it probably means forestry and agriculture. So first of all, define what you mean by it before you start investing in it. And I suppose the question is, what are we trying to achieve? Are we just trying to, buy some carbon credits, or actually you're trying to make a positive impact on biodiversity, maybe through re- or afforestation? So that's probably the first step. What do you want to do, and why should you be looking at it? So I think it is a new theme that investors are increasingly looking at. As I mentioned, COP15 and TNFD, I think that will increasingly force investors, particularly in the UK, to start looking at nature as a solution. So the first bit is, what does it mean? And the second bit is, how do you access it? So the challenge is, and I think this is one of the questions that came up at Eden, it's generally a long-term illiquid asset. So what is your appetite for illiquid assets? And I was talking earlier about the move from DB to DC. I think defined contribution is probably the future of saving. That's where new money is ultimately going. How do you access nature in a liquid format? Or does it just have to be in a liquid format? And what is your time horizon? And then, yes, you're right, the final bit is, what level of expected return are you after? And I think that's probably dependent on the type of nature you're looking to finance. Is it a capital intensive project, in which case it's probably higher because there's a higher level of uncertainty, or is it an income-based solution where maybe you're just looking to pick up a yield and not necessarily increase the stock of nature solutions, but just take income from them?
Exactly, I think that's a really good point. And part of the point you're making there is actually there are very, very different asset classes within natural capital. You could be investing in sustainable regenerative agriculture, where you're owning the land. You've got a land-based asset. It's probably relatively low yields, but it should be a relatively stable investment. At the other end of the spectrum, you might be investing in streams of biodiversity credits, which are basically a commodity that can be quite volatile in their pricing. So it is certainly one of those things where you need to get under the skin of a potential investment to analyse the risk-adjusted return. So you've talked a little bit there about measurement and management of biodiversity, and it's interesting to think about that alongside the climate piece. And I think part of the point you're making here is that biodiversity and climate are fundamentally intertwined, but they are both two objectives in their own right. And an example we might give is if you're looking at a forestry investment, there might be a trade-off between biodiversity and climate. Like if you're going to maximise your carbon value of a forestry asset, you'll be looking towards planting particular species, Sitka spruce, for example, in kind of regimented lines where you're just maximising growth. And that's quite different to focusing on biodiversity, where you may have a much wider range of species, focusing on broadleaf species, for example. So there is potentially a bit of a trade-off between climate and biodiversity. Do you see those as different thematics? And I guess the second question is, you've talked about the measurement of biodiversity and some of the challenges we have there. Do you feel optimistic for the future that we will see progress in these areas?
So on the measurement piece, I suppose, as I sort of alluded to, I think net zero has dominated perhaps to the detriment of other objectives, be it biodiversity or social or even governance, which was the easy win back in the day. We have a net zero commitment, so ultimately that is climate focused. So do we have a biodiversity target at the moment? No, but this is coming back to trustee objectives. It's probably something that trustees are going to have to start setting objectives around. It's the problem you've got is communication of those objectives. Net zero is quite a nice, easy phrase. Whether it's actually people still like the term net zero, I think is changing. I think people are trying to move away from that a little bit. How do you set an objective with biodiversity? You can't set a biodiversity target because A, it's quite difficult. B, how do you measure the success or otherwise of your biodiversity target? And then C, can you actually go and invest in that opportunity? So climate is, as you say, it's wide ranging. You can do it on the public and the private side. You can do it at the corporate level and at a project level. Biodiversity feels like it's more on the private space, and it also feels it's real asset based rather than on the corporate side. Clearly corporates have an impact on biodiversity, and their CSR policies might need to make reference to that. But whether that you can access that as an investment opportunity is probably a different question. So you start to narrow down the range of opportunities to access it. So you probably need to start to think about your portfolio in different ways. What are we trying to achieve overall? So it's net zero and certain biodiversity targets. And then identify the parts of your portfolio that you want to have maximum impact on those particular objectives. Because certain assets, it's just easier to do certain things. So for governance, it's easier to perhaps evidence governance changes at a corporate level. You can vote, you can use your proxy voting, you can abstain. It's probably a little bit more difficult at the real asset level. So try and identify what are you investing for, where can you have the greatest influence given the assets you're investing in, and what do those assets achieve relative to your trustee targets?
Got it. Okay, that's very helpful. You just touched on something else there. So we were really exploring biodiversity there and its kind of interlinkage with climate. You mentioned then social impacts. Obviously, there is a lot of discussion now about the just transition and making sure that this shift to a sustainable economy and sustainable energy in particular doesn't further erode the fabric of our society. What governments worldwide are making these commitments to decarbonisation through the Inflation Reduction Act, through what's been happening in the EU with the Net Zero Industry Act, through everything that's happening in the UK. Do you see any trade-offs there or balances that governments need to make between investment in the green economy and investments in other areas of the social fabric of our society, so in healthcare, in education, for example? Are there difficult decisions to be made there, do you think?
I mean, ultimately, yes, because nobody wants to see an area of the budget that's cut, and the idea if you need to fund something else, the money's coming from somewhere. But I think Chris Skidmore made a point around the traditional view is this is a cost. How do we mitigate the cost of net zero? It probably needs to be reframed as what is the opportunity for net zero? So certain areas of the country that perhaps, old mining towns, I come from an old mining town in the Midlands, that's probably an area where the industry just doesn't exist. How do you recreate those industries in those areas? How do you actually upskill people to take advantage of the transition rather than presenting it as a tax cost that they have to pay for? So that's probably the challenge, but that needs communication from everybody. So be it us as a pension scheme, why are we trying to achieve net zero? Why we don't actually see that as a cost on your pension. You're not going to receive a lower pension for it. I actually think you might receive a higher pension in the DC world with a lower level of risk. Governments obviously need to communicate it more effectively about the benefits to society, and that's how it needs to be phrased. So it's all about the messaging and why you're trying to do something, rather than just saying this is a cost. It might be a cost in the short term, but we're only looking to spend that money to achieve longer term objectives.
Exactly.
And we are a long-term investor. Ultimately, we have pension liabilities going out to 100 years. So although we think that 2100 is a long way away, we have members that will enter the workplace very soon who will be drawing benefits in the 2100s.
Yeah, that is extraordinary to think about, isn't it? And you try and project what the world might be like then, that the decisions we're making on infrastructure now are critical in that respect. And I think that Chris, probably better than anyone from governments globally, has articulated that point, the economic and the investment opportunities within net zero. And in a way, what Kingsmill has done is he's kind of set out the market forces that underpin this as well. So to make this point, that we simply have a decision now that is not about a cost of net zero. It's about making a decision between, on the one hand, an old, inefficient, fossil fuel-based system that's driving climate breakdown, with a new, efficient, renewable system that is integrated and provides reliable, clean power, and will help economic growth in the long run. But I think your point about probably learning some of the lessons of the past is really important here. If we look at the way the transition from coal mining happened in the UK, it was actually in a completely unplanned way, and it created a huge amount of a huge social cost. And so there must be lessons that we can take into account for the future.
Yep.
Peter, it's been brilliant talking with you this morning. I think to summarise then the kind of major points here. First of all, it's incredibly important for people to recognise, and for the investment community to recognise, the opportunity we have to harness the pensions and savings sector to help supercharge net zero. Secondly, that there is a huge investment opportunity within the sustainability transition as a whole. But thirdly, we do have these interconnected areas within it. We have interconnected objectives. We have the climate objective, we have a nature recovery objective, we have different investment themes within energy transition and natural capital. And I think what we've talked about today is a really good way of shining a light on how investors should be thinking about that. Is there anything else you'd like to add in terms of reflections or perspectives? And I guess, if not, I'll ask one final question to you. A question we were asking kind of everyone at Eden was, what gives you optimism and hope, and what do you worry about when you think about the sustainability transition?
So let me answer the first question in terms of key message. I think we've moved away from a world where net zero, biodiversity, and the other topics we discussed, they're purely a risk. They are now an opportunity. There are investment products and strategies available to us actually make a positive difference. So that needs to be the mindset. How do we play a positive part in this, rather than how do we shield our investment portfolio from the risks that this presents? So that'd be the key bit that I would encourage people to think about when designing and setting investment strategy. And then what makes me positive? I think if you go down to the wide range of people and stakeholders that are present, this is no longer a government objective. This is no longer a financial objective. Everybody has a role to play. And I think increasingly these are becoming more common conversations. I don't think we would have sat here 10 years ago and had a discussion about how we can factor in sustainability into investing pension capital. So the fact that everybody is now starting to recognise this is really important and different stakeholders are actively playing a role, that's the reason for positivity.
Excellent. Well, it's good to end on that positive note. So thank you very much for your time this morning, Peter.
Thank you.